Welcome back to our channel, where we demystify trading strategies and help you become a more informed trader. Today, we'll be diving deep into the protective put strategy, an essential tool for managing risk in the stock market. By the end of this video, you'll not only understand what a protective put is, but also how to execute it with confidence. Disclaimer: this video is for educational purposes only and does not constitute financial advice. Trading involves risks, and the protective put strategy may not be suitable for all situations. Consult with a qualified financial advisor before making any investment decisions. Past performance is not indicative of future results. Trading should only be undertaken with a clear understanding of the risks involved. Let's start with the basics. A protective put, also known as a married put, is a hedging strategy used by investors to protect their stock positions from potential downside risk. This strategy involves buying a put option for each share of stock you own. The put option acts as an insurance policy, providing protection if the stock's price falls. Why use a protective put? Well, think of it like car insurance. You don't plan to have an accident, but you have insurance just in case. Similarly, you don't want your stock to plummet, but a protective put is there to safeguard your investment. Components of the protective put. To execute a protective put, you need two components. Long stock position. This is the stock you already own or plan to buy. Long put option. This is the insurance policy. You purchase a put option with a strike price and expiration date. How the strategy works. Here's a step-by-step explanation of how a protective put works. Buy the stock at the current market price. Purchase a put option with a strike price and expiration date. The strike price should be set at a level where you're comfortable with the stock being sold. If the stock's price falls, the put option increases in value, offsetting your stock losses. Examples. Now, let's dive into some examples to illustrate the strategy. Example 1. Protecting profits. Imagine you own 100 shares of XYZ Inc. at $50 per share. You've enjoyed some gains, and the stock is now at $60 per share. You want to protect your profits. Buy a put option with a strike price of $55 and an expiration date in 3 months. If the stock falls below $55, the put option comes into play, limiting your potential losses. Example 2. Hedging against downside. This time, you want to protect against potential losses on a stock you own. ABC Corp., currently trading at $70 per share. Buy a put option with a strike price of $65 and an expiration date in 6 months. If the stock drops below $65, the put option minimizes your losses. You can still sell it at $65 even if the market price is lower. When to use protective puts? Now, the million-dollar question. When should you use a protective put? Before earnings reports. If you're holding a stock going into an earnings report, use a protective put to hedge against unexpected price swings. Long-term holdings. For stocks you plan to hold for the long term, protective puts can offer peace of mind during market volatility. Diversification. Use protective puts to diversify your risk management strategy, costs, and risks. Remember, there's no free lunch in trading. Using protective puts has costs associated with buying the put option. Also, if the stock doesn't fall as expected, you could end up paying for insurance you didn't need. In summary, the protective put strategy is a valuable tool for managing risk in the stock market. It acts like an insurance policy, protecting your investments against potential losses. However, like any strategy, it should be used thoughtfully and strategically. If you found this video helpful, please give it a thumbs up and subscribe to our channel for more trading insights. If you have any questions or want us to cover other trading strategies, let us know in the comments below. Thanks for watching and happy trading. TopGthinking.com.